who's the smart one? The guy who buys one solid deal a month, or the guy who buys three a month, and one's good, one's bad, one's okay.
Yeah.
And the good one pays for the bad one, and you're stuck with an okay one, right? It's do less of better quality.
Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hey, welcome back to the show. I've got Jim Sheils with me today. Jim, how are you doing today?
Good, Todd. Thanks for having me.
Yeah, absolutely. Appreciate you being on the show and excited to get going. Um, Jim is a real estate expert with a lot of knowledge and expertise in the build to rent niche, which I'm excited to have you on, Jim. I think you are the first build to rent guy that I've had on the show. So
Cool.
that's going to be awesome. Yeah. Partner at Southern Impression Homes, company that specializes in building rental portfolios in Florida's high growth markets for individual investors, institutional buyers, and you are also the co-owner, co-founder of 18 Summers, providing family education services to entrepreneurs. And I think that's really cool too. So I definitely want to dive into that. And you've written a couple books too, the Family Board Meeting and
Yep.
Passive Income Playbook. So we'll dive into those books as well. Jim, welcome to the show.
Thanks for having me. Yeah.
Absolutely. Why don't you give our listeners a bit more kind of about your background, and then let's start firing off questions.
Yeah. I went into real estate a little over 25 years ago. Like most people, wanted to try something different, kept going back to real estate, started slow by rehabbing old properties.
What were
And
you doing
that's,
before?
I was in corporate America for about 2 years, and that's all I lasted. I was in pharmaceutical advertising. And I remember sitting in my cubicle and reviewing a sales pamphlet on irregular bowel syndrome and wanting to poke my eyes out. And it just wasn't for me. And left the Northeast and moved to California for a sales job that was going terribly, and just knew I wanted to do something on my own. And I was in that entrepreneurial study phase of just looking at all different business opportunities. And I kept coming back to real estate. Real estate investing made sense to me. I like the tangibility. And it all started again 25 years ago, buying that first fixer-upper, which I was single and could starve myself. So I went pretty hard and fast at it and started to grab partners to come in on deals with me, and quickly built a business rehabbing foreclosures to either resell or rent out, and did well at that in California. And in 2005, decided to leave there and go into Northeast Florida, where I'm still headquarters today, and continued to do that. When the meltdown hit, definitely a painful time for what I owned, but also the deals were so incredible. I had tons of investors coming to me and say, let's partner. So I really went heavily into the bulk foreclosure market from about 2008 until about 2014. And by 2014, man, those deals just were getting
Yeah.
gobbled up, a lot of competition. The numbers weren't working. You'd have to cut corners on the rehabs, which I just didn't do.
Yeah.
And my now building partner approached me. We had done deals together, him and his father, at a pretty sizable management company, and actually managed my personal portfolio. And they said, hey, why don't we build our own investment properties instead of look for old houses to fix up for them? And that was the start of build to rent. It wasn't even a term 10 years ago. And now, fast forward, we've built over 10,000 properties. We
Wow.
are in 12 different markets, about almost $1 billion under asset management, 1,000 active investors. And we work with some of the bigger institutions, offer our own in-house financing, and specialize in single family, duplex, and quads. Like we were talking before when you and I were catching up, we'll do whole communities, or we'll do individual properties in existing neighborhoods. So that's definitely been in my journey to real estate wealth. My most lucrative and enjoyable time has definitely been building new properties instead of rehabbing old ones. And I know that's a little contradictory to most of the stories out there. I really appreciate my old houses, Todd, and going through those, and that's what really put me on the map for any sort of family wealth. But I am so glad I don't rehab old houses anymore.
Yeah, there's some challenges with rehabbing old houses. There's nothing like a new house, right? I mean, it's exactly the way it should be at the time you complete it. Of course, the day after you complete it, when the day somebody moves in, it starts to get old, but it takes a little while before it really starts to break down, unlike a pre-existing home.
Yeah, yeah. The new construction, once we started it, I mean, our turn cost, and owning rental property, you're listening to this, our turn cost went down 70% on average,
Hmm.
turning an old house compared to turning a new one.
Wow.
Average occupancy on one of our, renovated foreclosed homes, solid areas, but even so, the average tenancy was 13 months. Now with our new construction, it's almost 3 years.
Wow.
So those things are so important, because we look long-term strategy, long-term buy and hold. Those first few years are so important. You want to have less maintenance and repairs, less turnover, better, longer tenancy.
Yep.
And new construction has been able to do that. Also, we're getting planted in better areas, which, I will always sacrifice some cash flow up front for a better area and better condition. Always now. I didn't used to do that. And man, that was one of the most painful lessons I've ever gone through in my life.
Why painful? What do you see as the advantage or advantages?
Well, when I first went into this, Todd, it was buy as many properties as you could,
Yep.
and go cheap. And once you own 100 houses, your life is set.
Yeah.
I almost
Yeah.
doubled, and I was about double that. And what I found though, it's not about the number of homes, properties that you own. It was like, how do they actually perform? And with some of these older houses, I didn't realize the maintenance and repairs was going to be as high. I didn't know that I was missing certain key repairs. I didn't know the turnover was going to be so abundant and prevalent. And that was a very painful lesson. So I always tell people own less of better quality, because the disadvantage, and when '08 hit, and I was in more marginal properties than I knew, the amount of turnover and destruction was way worse on my baseline properties than on my properties little closer to the median value. And that was a very painful lesson. And that's just something that I want to avoid moving forward. Own less of better quality.
Yeah. I couldn't agree more. One of the things that I noticed, on top of what you said there, is that, 2008 to 20, 13 were the heyday of being able to buy these houses for cheap. I bought a lot of cheap houses in, you know, some not so good areas, some okay areas, and they all appreciated, which is great. But I look at the properties that I bought in really good areas and the properties that I didn't buy in really good areas, and even though they would have costed a lot more at the time, they appreciated at a far higher rate, and much quicker than the other properties. And so, beyond, again, what you've already mentioned, those higher quality properties in higher quality areas appreciate much faster. Typically, they go down less and they go up faster.
Yeah, in '08 here in Jacksonville, here's a great example. There were houses that were selling in some pretty rough areas of Jacksonville. And again, I was in California investing for years, so I was the newbie. Even though I'd done hundreds of deals out in Bakersfield, California, that doesn't mean anything coming to Jacksonville, Florida. Nothing.
Yeah.
Couple of fundamentals, but you don't know the areas. You don't know exactly the cost to fix things, and the tenant profiles of where's good, where's not. How do you screen best? It's totally different, state by state, and area by area. And when '08 hit, the cheap properties in some pretty tough areas, they were selling for about 80,000. Okay. They went down to 15 grand, 15,000. Now, the properties at a little higher end that were about 145,000 when '08 hit, those went down to 110. They were still selling at 110 to first-time home buyers, even through the '08. What does that tell you? Now, is that a drop? Yeah, but is it a drop like at that lower marginal property? No. And because when you are investing in an all investor owns neighborhood, there's no home ownership, it's all investors owning properties, there's more turnover, higher crime. I love to give to different charity organizations for building houses. but I don't mix charity with my rentals anymore. There was so much turnover and
Yeah.
destruction, and the management was so intense I couldn't keep up with it. I said,
Yeah.
why don't I just go to a little closer to the median? And that was closer to the median in Jacksonville at that time. And that just made all the difference.
Hmm. Yeah. Love it. Um, how was build to rent? Um, it became, like you said, like 10 years ago, not even 10 years ago, 6 years ago, 5 years ago, like nobody talked about build to rent, right? It's a
Yeah.
pretty new, I feel like when COVID hits, then all of a sudden everybody's talking build to rent. It became the trend. And there's a lot of companies that came in, started doing build to rent. There's a lot of developments that have happened that are build to rent. Is it overbuilt or is there still room?
Well, it depends on where you are. Again, as you know, real estate is very localized.
Yeah.
So certain areas I think have been overbuilt. Florida is still tracking at a deficit in housing. And so I think one of the biggest confusions too about build to rent, that there's still a need, especially for what we call infill lots. Some of the institution groups, they're going to come in, they're going to build their whole neighborhood of 240 properties, townhouses or single families, and it's all rentals. Most of the investors I know, we do infill lots. So we'll go into an existing neighborhood priced near the median. We'll buy up all the empty lots in like a 2 mile radius. And then we'll put single family homes and duplexes in these, neighborhoods that are already established, close to the median, with a good percentage of home ownership and renters balanced. And a lot of people don't think that's what build to rent is, but that's what it became for us. And those areas are really in high demand for where there's still that combination of homeowners and renters. That's what I like. Now we build for the institutions. They have their own money, their own game plan. They want an all rental owned neighborhood, and that's fine. I've always had a different mentality that we work in, and so those types are still in high demand. So the affordable housing, again, the workforce housing, affordable housing, the areas that we're building are still undersupplied. And again, just so you know, when you think of Florida, Todd, you think of Miami, you think of Tampa, you think of Orlando. We don't build in any of those markets because we're trying to find where it's affordable and where you can cash flow right off the bat in good areas. The land prices and the cost to build a home there is just so much
Hmm.
that you're going to have large negative cash flow off the bat. And that's not how we want for us and our investors.
Yeah. So you're looking for still strong markets, growth markets, but you want that affordable.
Ability is key. It's
Yeah.
absolutely key. And you can have the best of both worlds. Yeah, it's not going to have the luxury of South Beach, of course, but Jacksonville, Palm Coast, Ocala, Southwest Florida, like the greater Fort Myers area, we're building in those areas and we're getting strong fundamentals. There's great growth patterns. There's great job source. There's great lifestyle. And that's putting these types of workforce housing in high demand, especially being new construction.
What type of financing are you able to get for these when you're buying and when you're building these properties? What type are you getting local? Is it local bank or is it institutional? What kind of financing?
So we're in a really so two things with financing. Financing is absolutely key to a good build to rent company. And we've been in a position now where we've had to rescue a number of in small investors out there that we've seen 5 builders trying to do build to rent that have gone bankrupt in the last 6 months.
Oh,
Five.
wow.
And the issue was they weren't well financed. The banks wouldn't loan to them. And they just misdid their numbers with all the material price increases. Also, a lot of buyers were, with the rates jumping so high during the build time, there was problems. So what we do, Todd, is, we were partially acquired about 2 years ago by a group called Sumitomo Forestry. And they're over 300 years old. They're out of Japan. They give us the autonomy to run the company and fully finance us. We have no bank debt. And for a mid-sized builder like us, that's very rare. We have zero debt. We self-fund all of our builds. So we don't have any bank restrictions, or there's some good builders out there that are getting caught with that. And we're on a continual build cycle. So you don't buy anything from us pre-construction. We're building on our own dime, and one of our investors can step in and buy it when it's finished. So there's not some long escrow period.
Yeah.
So that's key for us getting the houses built. We don't have to listen to banks. My poor partner, he used to spend 20 plus hours a week getting loan conditions to our banking lines. We don't do any of that anymore. We're self-funded. And on the backside, since we're in such a good position, have a strong balance sheet, we're able to negotiate large tranches of money with banks for our buyers, for our individual buyers. So we are now, I guess, in the money buying business as well. We'll buy large chunks of mortgages and be able to pay up front to reduce the rate down. So where a lot of banks, you go into a main bank right now, and you're probably going to get quoted, let's say, for a duplex in Florida, about 6.75%. We are locking our people in at 3.75 right now. And that's 10-year money, 30-year AM.
It's
Or
amazing.
if you want 30-year, it's 4.25. So we're
Yeah.
able to beat the market 2.5 by 3 points because we're buying in large tranches of money. And we can only offer this financing on our new construction homes that we build.
Hmm. Yeah. Those are some good terms right now.
Yeah, that's
Anybody?
what people say they want to be back to 2021 mortgage rates. We're
Yeah,
there.
you're
We're
there.
there. And so we're that's keeping us very busy. That is absolutely, we're always trying to solve issues, Todd. First, it was the fixer-uppers that weren't in as good areas we wanted to be, and they had more maintenance and repairs and turnover. Good. We went new construction. We wanted to make sure, we could build our projects without slowdowns. We were acquired by a partner that funds us now, and then financing for our people. We now buy mortgages up front so that they can step into instant cash flow with low rates.
Somebody who wants to build new, to do development, what are some of like the big key things that you would say are really important to know, to do, to make sure you've got maybe it's the right people on the team. What are the like, 3, 4, 5 big key things that everybody's got to know or do to be successful?
Well, going from rehabbing houses to building houses is definitely a larger barrier to entry.
Yeah, I mean
Uh,
there's a huge difference there.
I think one of the biggest things is, people, remember a mentor of mine used to say, everyone wants to build the Taj Mahal before they own a duplex.
Yeah.
And here is, if you're going to start with building from ground up, start small. You hear about people, I got this incredible tract of land. It's going to be, 200 lots. I'm going to build the whole thing.
Mm,
The thing you got to realize is, and I said, well, how long do you think that's going to take to, get developed and approved? Oh, 4 to 6 months. Oof. I mean, it can be 2 plus years.
yeah.
So a lot of the things I say, we're all a little overexcited to get a piece of land in there, to get it properly done. You have a much longer period. It's not like rehabbing a house in 90 days and being done. And also there's some risk factor to taking on two big building projects, the unknowns. And I write about that in my last book. What I encourage people to do is start with an infill lot. You want to build a property on your own? Go to an existing area, an existing neighborhood, preferably with no HOA, but not in a bad area either. That'd be my recommendation. Um, and build in an infill lot, an existing neighborhood, strong fundamentals, the lot's already there in an existing neighborhood. It's easier to tie in, get approvals, and that's a good test phase. So that's what I always recommend to people because you try to bite off more than you can chew in the beginning, it can be very detrimental.
Yeah. Are you your own general contractor or do you hire general contractors?
We are, and in about when was it? 2018-ish. We were out in Ocala, Florida, and we had a builder go sideways with a
Mm,
bunch of our projects, and we were getting calls from subs and that they
mm,
weren't paid, and it was a nightmare. And we had to reach into pockets and really bail out the projects because we had investors buying them from them. It was a very expensive lesson. And from there, that kind of forced us to become our own builder. So from that time on, it was not easy, but we transitioned into becoming our own builder over that next year. And it's one of the most important things we ever did, Todd, because honestly, when the pandemic hit, and builders were so sparse to get work done, right? They were all
yeah.
so to be able to get a builder to be in between us and our projects, it would have been way too costly, way too slow. So it's good we became our own builders because we'll never be in the position again where we risk someone else being in charge and supposed to pay the subs and not, we are always going to be, very close to the source on that from here forward.
Yeah, that makes sense. I mean, the more I think the more you can control, to a certain extent, right? But the more you can control, the better. If you have to be able to control who's on site and who's getting paid and all of that, and if you're leaving it up to a contractor, not that you can't be successful if you have the right contractor partner, that's great. But if you can control that, especially the scale you're doing, makes so much more sense. Let's talk about you got a couple books out there, and I want to talk about 18 Summers because I think it's such a cool, you know, I guess philosophy idea. Let's talk about 18 Summers, what that's all about.
Yeah, I wrote a book with my wife about 10 years ago, and it just got legs and got a following, and then a publisher picked it up a few years ago, and it went to #1 on Wall Street Journal. And none of this was expected. And it's not that we're that good at writers. I think it was that of a message. And there was terrible advice out there years ago. Get out there, whatever you're going into some sort of entrepreneurial pursuit or real estate investing. I worked with a lot of real estate investors like myself. Some of the advice was put your head down for the next 5 or 10 years, get back to your family, then they'll understand. I think that's horrible advice. I think that's
Mm.
horrific advice. A mentor of mine said their years are not all created equal. And then I read a study that, the average person will spend about 85% of the quality time that they ever have with their children by the end of the 18th summer. And
Pretty
uh, and
crazy.
that is very powerful. And I have 5 children ranging from 3 to 21. So I've been through the gamut and I'm still going through the gamut. And it's very true. They'll always be your kids, but it starts to become different. As they grow up, they spend less time with you. And also what I learned is if you do those first 18 right, then they'll still want to come back.
Mm.
We've done some coaching and consulting with some very successful people who their children after 18, they're not really around, nor do they want to be around. And that's a crushing situation where kind of all of your success in business has now just been, all for naught, at least in my opinion. So we wrote books. How do we stay successful in business and successful at home? You have to be involved with family along the way. It's crazy not to. And that's what our first book, The Family Board Meeting, was about. Some simple strategies that are now being used by a few 100,000 families worldwide that really help you keep grounded and not lose yourself in your business, while trying to keep a strong marriage and hopefully a relationship with your children.
Yeah, one of the things I always have struggled with is I want to build and grow a business, right, and be successful at that. And I also want to see my kid. I want my kids to be able to see me as a role model, somebody that works hard, somebody that's not just lazy and doing nothing, right? But you also want to be able to make sure you're spending high quality time with your kids.
Yep.
And it's easy, especially with these pocket devices, computers that we all have. It's easy to get really distracted and get caught up in your work and but yeah, I man, it's tough. It's really tough to be involved with your kids and to also be growing the business. So anybody who's going through that right now, especially if you have young kids and a young business, I think that's really hard. Um, I think you said it earlier, like if you're single right now and you're wanting to go, or if you're even if you're married and you don't have kids and you want to get that business going, to like do it now. Like that's a great time. Because once you have kids, it's definitely you can ignore them, I guess, but man, that's not a good way to go.
No, no. And I see a lot of regret where people would trade back a lot of their balance sheet for a retry, and we don't get a retry. But I think you can have success in business and success at home. And I talk about some real simple strategies and rhythms that you can put into practice. And again, this we sometimes share lessons that we needed to learn. I needed to learn all these. How do I, with my family coming out of the '08 meltdown, wow, I had lots of pain and unknowns. And so how do you still stay present in those moments?
Yeah.
How do you not get wrapped in? And one of our biggest things is it's funny you said that. One of our big principles we've gotten known for is instituting in your life and your family's life the principle of intermittent tech fasting. So you're not, if you've heard of intermittent fasting, you're a fit guy, it seems, you're not giving up eating, but intermittent fasting has been shown to for good for muscle recovery, weight maintenance, organ revitalization. You're not giving up eating. You're only deciding to eat between this time and this time for a good reason. Same thing with these electronics. There has to be times when you're completely and totally unavailable without guilt. And that's the only way to truly be present for your family, because
Yeah.
we call it half-in parenting. If you
Yeah.
always have your phone on and there's that badge of honor, oh, my investors or deal sources can get to me anytime. But if that means at any time you're with your family and you'll take a call, you'll take a text, you'll read a useless Facebook thread, it can be absolutely detrimental to the strength of the family. So you have to have times to step away for you, for your kids, and it'll reignite deeper relationship.
Yeah. And I'm guilty of being that person that takes the call and at any time of the day. But I think that your investors or your partners or people that you do business with, the vast majority, like 99% plus, will respect you more if you're not answering your phone at certain times of the day because you're spending time with your family.
Yeah.
If
Yeah.
you're available at all times, there's just, I don't know, it's just, to me, you're not as successful if you're available at all times. That's my perception with somebody. So you want to be not available at certain times of the day because you're spending time with your family. You're not working at that point in time.
Exactly. Exactly. And you'll be refreshed, recharged, and refocused. If you're always half in, you're kind of at like this flat line,
Mm,
both with work and with family.
yeah.
You're like, gosh, I'm not really performing at home, or I'm not really present. And that causes guilt, depression, bitterness. And you're like, oh, but I'm not really paying attention to work. When you separate the peas from the carrots and you give full focus at different times without guilt and just full confidence, you show up better in both.
Yeah.
And that's what people don't understand. It took me a long time to understand. I'm still a work in progress, but man, I've gotten a lot better. That when it's time to be working through my top priorities in work, I'm fully on. If I'm with my family, you can't reach me. If I'm on date night with my wife, which is a big thing, my wife and I actually teach on in our 18 summers business, like one of the worst things you can do is not have a weekly date with your spouse, in our opinion. The second worst thing you can do is set that and be on your phone the entire time. And I'm the dummy who did that, Todd. So you won't see me on my phone on a date.
Yeah.
Unless my wife and I are searching for a next adventure we're planning or something. But normally
Yeah.
my phone's not with us. It's in the car.
Yeah.
And I don't want
Yeah.
anyone trying to get to me. And these simple, again, this intermittent tech fasting, once you start to put it in, maybe at the end of the day, over the weekends, during holidays, during date night, during what I do these quarterly days with each of my children, my phone will never get in the way. And that's when real connection opens up. That's when kids especially will start to share things. You're going, man, where have I been that they wouldn't share this before? A lot of times when we've interviewed kids, Todd, they've gone through something big. Well, my parents just seemed so busy, so I never brought it up to them.
Mm,
And sometimes we're on a useless thread on something on the phone, and it's like
yeah.
put that thing down to make yourself more available.
Yeah. Good reminder for everybody listening, including myself. Just put the phone down, leave it in your office, find a spot in your house that you just keep it, just put it down, plug it in, whatever you got to do. And just leave it. One of the things I do when I'm on business meetings actually is I was just at a lunch meeting today and I left my phone. I put my phone in my glove box in my vehicle and I just left it there. And I go into the meeting and because I don't want my phone to vibrate, to, ding at some and immediately just even just to glance down and take my attention off that conversation. That just
Yeah.
derailed that conversation. Shows a sign, in my opinion, of disrespect. And it just it doesn't give the right vibe. It doesn't allow me to concentrate. Now I'm thinking, oh, who just texted me? Who, what's going on? Right. And I'm not paying attention to that conversation.
Exactly. Exactly. It pulls you out without even looking at it.
Yeah. I listened to it last week. I was out elk hunting in the mountains and I was listening to a podcast and um, it was I can't remember who it was, but they were interviewing a billionaire and they asked that billionaire, um, you're a billionaire, you've made piles of money, you got a great business. What's your definition of success? And the billionaire, uh, God, I wish I remembered his name. He said, "My definition of success is that my kids still want to talk to me."
Huge, isn't it? I have the same one. I always say my kids still want to hang out with me.
Yeah,
So pretty close. I mean, same thing, but
same thing. Yeah,
that comes down to it, doesn't it? That's very powerful.
awesome. Uh, Jim, what's a mistake that you have made, business, family, whatever, wherever you want to take it? What's a mistake you've made, and how can our listeners learn from it?
I think we've been hitting on it. I got wrapped up in being a deal junkie, and
Me too.
and if who's the smart one? The guy who buys one solid deal a month, or the guy who buys three a month, and one's good, one's bad, one's okay,
Yeah.
and the good one pays for the bad one. And you're stuck with an okay one, right? It's do less of better quality. That's
Yeah.
one of the things where I think there was good intention from some real estate investing teaching, but I didn't really look at fundamentals. I just looked at gross volume.
Yeah.
And,
The
and that
deals.
was a big mistake. And the quality of the deals, that's just so important. So that's a big mistake I made. And then I think, personal and family wise, if you're going to be in this game, I don't know many people that have had just this straight hockey stick line.
Mm,
There are ups, there are downs, there are cash surpluses, there are cash shortages, there's deals that go right, there's deals. And, I let myself get wrapped up in the emotion of fear or worry too much.
mm,
And,
yeah.
the more I can let go of that and just keep not a Pollyanna, but a positive solution to this. There's a lesson to this. What does this look like to move through? It just works out so much better. And that's works business, but you bring that home with you, that worry, that fear, and your kids feel it. And so that's a mistake I've made. And I would go back and say I would take less of that emotion, welcome less of that type of emotion.
Yeah. Easy to get caught up in it though. I think that's humans like thrive on fear. So it's hard to, I don't think you can ever get rid of the fear, right? But you have to work past the fear. I think that's the key is how do we work past the fear and be persistent and continue to push on.
Exactly. Exactly.
Yeah. And I love the I did the same thing, man. Like, oh, I'm just volume, right? I'm trying to flip as many houses as I can, buy as many rental properties as I can. And the more I did, the better I felt. I remember just thinking, I want to be so busy that my head spins. That was like that was literally for a while there. Like, that's what I wanted. I want to be so busy that I had a headache at the end of the day because I was so freaking busy. That was my idea of success. And so I created that and I was doing so many dang deals, and very few of them were actually making good money. So many of them were just making just little marginal returns because I'm doing this huge amount of volume, and I'm just like completely stressed. Sounds like you were doing something similar than me. Um, and I don't know about you. When I slowed down, it actually was really hard. It was really hard for me to slow down and do less volume because I felt kind of like a loser, like I wasn't doing
Yeah.
enough. I don't know if
Yeah.
you felt the same way.
Yeah, I think as you're programmed into this, you have to do volume, and volume is that badge of honor, or where you
Yeah.
can show up and you've really proven your worth in certain circles as a real estate investor. But I have now, yeah, I've really come to peace with that. I say that now I'm doing more of a volume than I ever have, flipping homes, but I also have a team of 140. So that's a
Right.
totally different
Totally different.
situation. But I had to take my foot off the gas to reassess things. And a lot of the times, what I say is at first it was hard, like you said, Todd, but after that, like how much better can you look around you or be in a good position to, turn or maneuver if you're driving 25 miles out an hour in a 50-mile-an-hour zone, or if you're driving 70 in a 45,
Right.
when you're driving 70 in a 45 opposed to 25 in a 45, you're able to look around and there's not a lot of, you're still moving and you're deliberate, But man, you're going 75 and a 45. This is where accidents happen or swerves or you're, and it's like there's some high to that, but in my old age now of 25 years in this, I'm like, yeah, I don't really need that type of excitement
Yeah,
anymore.
yeah, I hear you. Well, cool. So I got a couple last questions, Jim, before we wrap up. So a question I always ask, what's a favorite book you can recommend other than your own, of course?
Yeah, no, I never recommend my own. I would
Well, you
never.
should. You should, right?
You should. Like
The
I said,
family board meeting, I'll recommend them for you. The family board
yeah.
meeting and passive income playbook. So,
Yeah, no, I mean, I think those will help real estate investors. One of my favorite books that I was just talking to my wife about this morning that I read twice with my sons was The Alchemist. It's just a great
mm,
story form book. I really like that one. So that's a great starting book, I think, for a lot of people. So it's just one.
uh, you read that to your kids?
My older boys and I, we would always read a book a quarter. Which
Cool.
is a one book a quarter, not a bunch of them. So we've read
Yeah.
anything from Alchemist to Think and Grow Rich to
Yeah.
Rich Dad Poor Dad to Seven Habits of Highly Effective Teens to yeah, just we have a pretty good list of books that we've read.
How old were they when you started doing that?
Well, about 13.
Yeah, that's
About
cool.
13.
My son and I went on a camping trip this summer, and I brought The Richest Man of Babylon
Oh,
along
one
with.
of our favorites. I'm surprised
Yeah.
I didn't say that. That's one of our favorites.
So I read that. I was reading that book to him every night before, as he would kind of lay down to go to sleep. I'd read it in the tent, and he just was like, "Dad, keep on reading, keep on reading." I just loved that book.
It's a
So
great one.
yeah, I got to
Yeah.
start. I
Story form.
we never finished it, so I got to pick it back up and start reading it again to him. That
Yeah.
I
My
think
boys,
that's
that'd be one of the
it's one of the coolest things you can do with your kids. Is like they they wouldn't read it on their own probably, but if you read
yeah,
it to them, I think most kids just love their parents reading to them and pick up a book that maybe is above their reading level or maybe at their reading level that they can at least understand and read it to them. I think kids will love it. So,
absolutely. Absolutely.
all right, last question. What are your three pillars of wealth creation?
Owning real estate, owning business, and quality time with family and friends.
Love it. Love it. Jim, look, man, really appreciate this. I mean, lot of great stuff listeners can go back to. How can they get in touch with you? How can they learn more about what you got going on and be in
Yeah,
touch?
if they want to learn more about us, they can go to about our just build to rent. Go to jjplaybook.com. That's a good starting point to learn about our build to rent business and kind of some of our family strategies to keep a stronger family life.
Cool. Cool. Awesome. Any last parting words that you want to say before we wrap up?
No, I think it's great conversation and some real good nuggets here.
Awesome. Well, Jim, again, really appreciate it, and you have a fantastic rest of the day.
You too. Thanks, Todd.
Hey, thanks so much for listening. I appreciate you being a loyal listener. Say, I would love to have you go on to our Facebook page and subscribe. Give us a thumbs up. Go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out. And we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.